Today, the bear bounce, the DFA daily to the 25th of March 2020. Hello again, it's Martin North from Digital Finance Analytics. Welcome to the latest post covering finance and prop news with a distinctively Australian flavour. Another day, more headlines from around the world, all pointing towards more difficulties in the financial markets, which of course underscore the fact that this is a deep and serious issue. I'm going to start with news from the UK. The Bank of England launched a contingent term repo facility, and they said that this step is designed to help alleviate frictions observed in money markets in recent weeks, both globally and domestically. The CTRF is a flexible liquidity insurance tool that allows participants to borrow central bank reserves cash in exchange for other less liquid assets collateral. The bank's liquidity insurance facilities support financial market functioning by providing market participants with predictable and reliable sources of liquidity. The bank's liquidity insurance facilities support financial stability by reducing the costs of disruption to critical financial services. Holding additional CTRF operations over the next 2 weeks complements the bank's existing liquidity facilities. The CTRF will run alongside the bank's regular sterling market operations, the index long-term repo and discount window facility. The bank is also able to lend in all major currencies through its participation in the central bank swap line network. The CTRF will lend reserves for a period of 3 months. This will also allow participants to use the CTRF as a way to bridge beyond the point at which drawings can be made from the term funding scheme, with additional incentives for SMEs, helping to support lending to the real economy as quickly as possible. Now, this is quite interesting because it really gets to the heart of what's going on, and that is central banks around the world are putting more and more liquidity and more mechanisms in place to support the financial plumbing across currencies, across countries. And the combined efforts, I think, will be somewhat successful, at least in the short term. And I have to say, the risk of a bank failing in this environment probably has gone down a few notches simply because of the amount of central bank liquidity and support being provided around the world. But of course, you have to ask the question, who is paying for all this? And the answer is they are simply creating more liquidity, creating more funds, if you like, out of thin air, and ultimately devaluing the real value of money in the process. And that, of course, hits us and everybody else over the long term. But nobody wants to think about that. Everybody's trying to deal with the immediate short-term plumbing needs. So it's not that surprising that we see the Bank of England doing what they've done. Now to the US, and there are two things we want to talk about. Firstly, of course, the US markets overnight did quite well. They actually moved up, if you look at the Dow, by more than 11%. And that's the biggest percentage rise since the early 1930s. This is a classic bear market bounce. In other words, markets don't fall every day in a bear market. They will sometimes bounce as well. And that's what we saw, I think, today. And you can expect more volatility ahead. And earlier on today, it was reported that the Trump administration and Senate Democrats were close to a nearly $2 trillion stimulus plan and economic rescue package after days of tense negotiations. And of course, wherever you look, you see industries trying to get help from the central banks. So, for example, there was a report in the US relating to the $16 trillion US real estate trusts who are in trouble. Now, the business model of a mortgage REIT is to buy long-term residential and or commercial mortgage-backed securities and leverage them up by borrowing short-term, including in the repo market if they can, while posting the RMBS or CMBS as collateral. A mortgage REIT makes money off the spread between the borrowing rates and the yields of the mortgage bonds, and they multiply their profits through leverage. That's their business model. That's what they're designed to do. And as Wolf Street says in their post, during the good times, it's like free money. And the mortgage REITs paid big fat yields, and then suddenly the good times were up. Everyone was trying to unload them, and their prices dropped, and therefore collateral values dropped, and financing counterparties sent out margin calls to get more cash or collateral to make up for the dropping collateral values. And then, well, it all went terribly wrong. So on Monday, TPG Real Estate Financial Trust, sponsored by private giant Equity TPG, which had spun it off in an IPO in 2017, announced that it's still been able to meet margin calls by posting cash collateral. But, quote, if the requirements to post additional cash collateral continue to be material, there is no certainty it will be able to meet future margin calls. To preserve liquidity, it would delay paying its previously announced dividend. And so their shares dropped 30% on Monday and 13% on Tuesday, and are down nearly 80% from the last glory days, actually February the 20th, so not long ago. The company, they said, is engaged in active discussions with its lenders and other potential sources of financing, but it cannot predict whether it will be able to agree to terms with such parties on an expedited basis. And it's going for a government bailout, it said. The company is also monitoring the potential availability of government programs. So taxpayers are being looked to help support it. And in fact, there were another 3 real estate trusts in the US who were playing similar games with difficulty in meeting the financial commitments that they had. Now, this is a classic illustration of the problem we have at the moment, and that is we have a very complex set of financially engineered business models that are all based on the predication of markets going up and money being generated out of nowhere. And yet when things go wrong, guess what? They all grizzle and then turn around and try and get money from the government or from central banks. So it's the old adage, you privatise profits, but in the downturn, you turn to the public purse to get a bailout. Doesn't seem very fair to me. And to just illustrate the degree of distress that there is around the place, there was a very good article which I titled A Speedy Journey Downward. And the article read, the trifecta of risk, the medical emergencies, insufficient economic policy arsenals and geopolitical white swans will be enough to tip the global economy into persistent depression and a runaway financial market meltdown. After the 2008 crash, a forceful though delayed response pulled the global economy back from the abyss, but we may not be so lucky this time. This was contained in an article from Project Syndicate, and it said that the shock of the global economy has been both faster and more severe than the 2008 global financial crisis and even the Great Depression. In those 2 previous episodes, stock markets collapsed by 50% or more, credit markets froze up, massive bankruptcies followed, unemployment rates soared above 10%, and GDP contracted to an annualized rate of 10% or more. But all of these took around 3 years to play out. In the current crisis, similarly dire macroeconomic and financial outcomes have materialized in 3 weeks. Earlier this month, it took just 15 days for the US stock market to plummet into bear territory. That's a 20% decline from its peak, the fastest such decline ever. And now markets are down around 35%. Credit markets have seized up, and credit spreads, like those for junk bonds, have spiked to 2008 levels. Even mainstream financial firms such as Goldman Sachs, JP Morgan and Morgan Stanley expect US GDP to fall by an annualized rate of 6% in the first quarter and by 24 to 30% in the second quarter. And even the US Treasury Secretary warned that the unemployment rate could skyrocket to above 20%, which was twice the peak seen during the global financial crisis. In other words, every component of aggregate demand, consumption, capital spending, exports is in unprecedented freefall. And while most self-serving commentators have been anticipating a V-shaped downturn, with output falling sharply for one quarter and then rapidly recovering the next, it should now be clear that the crisis is something else entirely. The contraction that is now underway looks to be neither V or U or L, a sharp downturn followed by stagnation. Rather, it looks like an I, a vertical line representing financial markets and the real economy plummeting. Not even in the Great Depression and World War II did the bulk of economic activity literally shut down as it has in China, the United States and Europe today. The best case scenario will be a downturn that is more severe than the global financial crisis in terms of cumulative global output, but shorter lived, allowing for a return to positive growth by the fourth quarter of this year. In that case, markets would start to recover when the light at the end of the tunnel appears. So wrote the author Nouriel Roubini, Professor of Economics at New York's University's Stern School of Business. And that is really the point. We are in uncharted waters. We do need the central banks to support the banking system and the plumbing, but of course it's the question of will they be successful and what are the costs going to be? And just the latest on the US, because we heard quite recently that the White House and the Senate has now pretty much agreed the $2 trillion deal. The White House and Senate leaders has reached a deal early on Wednesday morning, US time, on a massive stimulus package they hope will keep the nation from falling into a deep recession. The agreement caps 5 days of intense negotiations. The revamped Senate proposals will inject approximately $2 trillion into the economy in the form of tax rebates, 4 months expanded unemployment benefits, and a slew of business tax relief provisions. The deal includes $500 billion for a major corporate loan program through the Federal Reserve, a $367 billion small business rescue package, $130 billion for hospitals, and $200 billion for other domestic priorities such as transportation, veterans, childcare, and seniors. And the bill will give a one-time check of $1,200 to Americans who make up to $75,000 a year. Individuals with little or no tax liability would receive the same amount, unlike the initial GOP proposal that would have given them a minimum of $600. And I just want to highlight again that hundreds of billions of dollars in buffer capital was agreed for the Treasury Department to allow the Fed to hand out an additional $4 trillion in loans to distressed companies such as US Airlines and Boeing, the nation's leading airplane manufacturer. Their stocks have been hit the hardest in the recent stock market sell-offs that have erased the gains made since President Trump took office. And in fact, the rating agencies have downgraded Boeing, for example. The Fed loan program, which Democrats bashed as a corporate bailout program, Munchen's slush fund, was one of the biggest sticking points during the late rounds of the negotiations. Republicans argued the Treasury Department needed $500 billion to help the Fed inject enough liquidity into the economy, while Democrats were enraged over a provision that would let Munchen provide loans and guarantees and then wait 6 months before disclosing who got the assistance. So let's be clear, this package is putting some money directly into the hands of households, but there is a lot of money being made available to bail out corporates, those very corporates who've been buying back their shares with bonds with low interest rates, and those who have prospered over the last few years on very high stock market multiples. There's something wrong here at the very heart of what's going on. And coming back more locally, the fallout from what's going on at the moment is going to be broad, deep, and touch many different segments. But I think the education sector in particular is going to find it very difficult. And today I posted a conversation that I had with Salvatore Babones, the Associate Professor at the University of Sydney. He published a paper recently that highlighted the fact that the international education sector is likely to be decimated. And of course, Australian universities have become very reliant on international students, which have now been turned off. And he argues that there are profound implications for the future of the education sector. Yes, another reason, well, they'll be knocking on the government's door for some more money down the track, I suspect. Now, the reason I'm going into some detail here is that part of what I want DFA to do is to begin to lay out some alternative options and thoughts about where we take the economy beyond the current crisis. Because it's clear to me that the last 30 years have really not led us to somewhere very good at all. Huge levels of debt, huge leverage, and of course now central bank intervention to support the plumbing. So we need to find a different path. And I had a very interesting conversation with Guy Standing, who's a professorial research associate at SOAS, University of London. And he is very strong on the need for social reform centred around the universal basic income. Now, it's interesting when I put this post up, I got a lot of negative comments relating to the video because everybody sees this as somehow a welfare-led approach, but it's not. And I do suggest that you should listen to what he says. Essentially, he's saying what I've been saying, and that is that ordinary people are being crushed by the debt-driven system, and that debt-driven system serves the 10%. It serves the big corporates, it serves the banks, and of course the government and the politicians are all on the same side. And yet it's not doing real people any good at all. And his argument is that universal basic income could definitely be part of a solution. And indeed, pilots have been run to show that UBI helps people to become more confident about themselves, increase their education levels, and to become economically more successful. And that's, I think, my key point. Whether you believe in UBI or not, we need to get some alternative thinking going, because otherwise we're just going to continue down the same old rabbit hole. And even if we manage to see this crisis out, nothing fundamentally will change. I think change is required. And my own view is that what Guy is talking about is definitely worth considering. And if you want any further evidence of the trouble that we've got locally, then look no further than the ANZ Roy Morgan Consumer Confidence Index, which came out yesterday. It fell by a massive 27.8% from last week, and that fall has brought the headline index to just above the all-time lows recorded back in 1990. Confidence was 17% below the lowest point seen during the global financial crisis back in October 2008. And they said that all subcomponents of the survey plunged. Current financial conditions fell 23.9%, while future financial conditions dropped 25.8%. The economic conditions sub-indices were also down sharply, with current economic conditions falling 37.1% and future economic conditions down 19.1%. And the time to buy a major household item fell the most, dropping by 37.2%. The 4-week moving average for inflation expectations was stable at 4%. And just take a look at this chart in detail. Remember I mentioned the eye shape? Well, here you go. Here is the eye. The fall in confidence has dropped massively. It's also, by the way, mirrored in my own research, which I'll be publishing shortly too. Households are in a completely different space now. They're not going to spend, well, they can't spend perhaps because of the shops being shut, but they neither have the wherewithal to spend nor the will to spend. And this bodes very badly for the economy ahead, even once we get through the immediate crisis. And just before I review the markets, let me just talk briefly about Italy, because in a way, Italy is probably right in the crosshairs of what's going on. And to prevent bond yields from rising, Italy needs a bailout now, not later. Specifically, it needs a dedicated firewall of at least 500 billion euros. This is because if bond yields were to rise too high too quickly, Italian public finances will deteriorate, and Italy will then be increasingly unable to roll over its debt. The European Central Bank is the only authority with the wherewithal to finance this bailout, but they won't do it at the moment. Now, the bond market has been pricing in explicit ECB guarantees concerning Italian sovereign debt. Thus, should the ECB fail to act, this could become another credit crisis trigger. So the ECB is basically being held hostage by the bond markets. At present, the ECB only has the authority to purchase an additional 150 billion euros of Italian debt before it breaches the self-imposed 33% issuer limit. German and Dutch hawks on the ECB Governing Council have expressed opposition to even contemplating any breach of this ceiling. This impending bailout will test European political unity shortly. The ECB must ride to the rescue over the objections of the fiscally upright German and Dutch council members, assuming all of the repugnant moral hazard that comes with that. The only alternative is an Italian default and subsequent Italexit, which would send shockwaves reverberating through financial markets worldwide, and it will probably blow up the Eurozone in a heartbeat. And again, you can see the stresses and strains here as the bond markets tussle with the financial system. And I come back to my key point. We have inflated the global debt to a level where it is uncontrollable. We are raising even more debt, which means it will be even more uncontrollable. And everywhere you look, there are pressures and pinch points in the global financial system. And I'm not sure that anybody knows whether they can put the genie back in the bottle or not. But frankly, even if they do, they're just inflating the bomb for a future debt explosion, because this is just not a sustainable path that we're on. So turning to the local markets, the ASX 200 was up another 5.54% today to 4,998. The financials index was up 8.67% to 4,163. And the real estate trusts was up 7.19% to 1,011. The volatility index was locally at 4.25% higher, and that was at 43.73. So volatility indicates uncertainty and risk, and it's higher. And the ASX 200 futures was up 2.61% to 5,128, signalling potential rises tomorrow. But it depends, of course, what happens in the US. ANZ was up 9.9% to 1632. The CBA was up 5.36% to 60.05. The NAB was up 5.69% to 1522. Westpac was up 5.93% to 1537. The Bank of Queensland was up 2.13% to 480. Bendigo was up 4.94% to 574. Suncorp was up 4.93% to 851. And Macquarie was up 5.1% to 83.02. AMP was up 2.7% to 1.14. Genworth, the mortgage lender's insurer, was up 5.26% to 150. And McGrath, the real estate agencies, was up 12.5% to 18 cents, while Yellow Brick Road was at 5.1 cents. Aggregator AFG was up 9% to 109, and Mortgage Choice was up 10.71% to 62 cents. And Building Infrastructure Group, CIMAC, was up 2.56% to 22.46. The Aussie US dollar rate was at 1.63% higher to 60.50. So we've broken above 60 for the first time for a few days. And the euro Aussie dollar was down 1.22% to 1.788. The 2-year bond was down 3.05% to 0.286, and the 10-year bond was down 0.51% to 0.975. The gold Aussie cross was down 0.17% to 2,643, while the Bitcoin Aussie cross was down 2.64% to 11,129. And just jumping ahead to the US 500 futures, it's up 1.28% to 2,469, which suggests that rates in the US may go higher. And the Nasdaq futures was also up 1.14% to 7,641. So we are in a bit of a run within a bear market. But remember this, it is impossible to value companies at the moment because nobody knows what their future cash flows will be, because it all depends on what happens with regards to how long the medical emergency runs, how deeply the economies need to be iced to be able to deal with threats, and how quickly they bounce back. So frankly, any stock price is a speculation at the moment, and any movements up or down are frankly random because there is nothing really underpinning it. And of course the markets are reacting to the news from the US, but if there's bad news, then they will fall away again. So this is now the pattern that we're going to see, I think, over the next few weeks. So I'm expecting more volatility. I'm expecting tighter clampdowns across the world. We've already seen another circuit of those today in Australia, and of course New Zealand is tightening the screws as well in terms of keeping people close to home. And in a way, that's the critical first step. But the second step, beyond the immediate medical issues, relates to a discussion that we need to have about the future shape of the global economy and the supporting financial system. And over the next few weeks and days, I want to have more of a conversation about what some of those future options may be, because I am not convinced that just yet more debt and yet more debt again is actually the most sensible steps to take. And yet, of course, that would be orthodoxy for central banks and governments around the world. I think it's going to be a really interesting ride. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.